Hello, good afternoon. You've tuned into MF Corner on CNBC TV 18. I'm Vinnii Motiwala. Thank you so much for tuning in as always. Now, today we talk about income plus arbitrage fund of funds. And this is what we'll be discussing because this has been picking up pace. What does it actually mean? What are these funds? For a layman, income plus arbitrage fund of funds invest mainly in arbitrage as well as debt mutual fund. So, you should have both as a separate fund or just income plus arbitrage fund. What should your strategy be as a mutual fund investor? That is what we're going to be discussing in this edition of MF Corner. And today to discuss that, we have Gaurab Parija of Bandhan Mutual Fund joining in with us to talk to us about that. Gaurab, good afternoon. Thank you so much for joining in with us on the show. And, you know, this is such an interesting topic because it's picked up pace right now. Income plus arbitrage fund of funds. Firstly, if you could start by telling us what is it exactly and how does it differ from maybe a traditional debt mutual fund or an arbitrage fund? How is it different here?
Firstly, good afternoon, Vinnii, and thanks for having us on the show. As the name suggests, I think the income plus arbitrage fund of fund is a strategy which invests into two different funds, the underlying funds being debt fund and the arbitrage fund. And it's wrapped as a fund of funds. The broad difference between this and the other categories is that a debt fund typically would invest directly into, depending on the type of fund, into corporate bonds, government securities, money market instruments, whereas an arbitrage fund takes exposure to the futures markets, basically buys cash and sells futures to capture the opportunities. What the income plus arbitrage does is very conveniently wraps both of them into one simple structure. By putting a certain percentage in a debt fund and the residual in an arbitrage fund so that the investor need not toggle between these two categories of funds.
Okay, so that's the basic difference that we have coming in here in terms of what is income plus arbitrage fund, debt funds as well as arbitrage fund. Income plus fund is just combining both of them, so it becomes easy for an investor as well. So in terms of how does the asset allocation typically work for these income plus arbitrage fund of funds? What is the amount of debt? What is the amount of arbitrage here? What is it versus in terms of a debt fund will be pure debt fund and arbitrage strategies? How is it different in terms of asset allocation?
It's a very nice question. I think the genesis of this strategy came through the tax amendments in July in 2024. And that gave birth to this category to classify or to qualify for this income plus arbitrage. The typical allocation is you need to have investment in arbitrage funds greater than 35%, with the residual in debt funds being around 65%. And that's broadly the strategy. The underlying debt funds is left to each fund manager's choice. Some have it open-end that they could go across all debt fund categories. Some are limited to one particular set of funds. And that's how it broadly differs in terms of asset allocation. So to sum up, arbitrage funds would be more than 35%. The residual will go into fixed income funds.
Okay, so arbitrage will be 35%, the rest will be in terms of fixed income. And this is for income plus arbitrage funds. Gaurab, what are the main advantages of investing in income plus arbitrage fund of funds compared to maybe firstly a fixed deposit and also then if you could compare it to pure debt mutual funds also? What are both the benefits and risks if you could highlight for both these parts?
So let me break this into three parts. First, from a tax efficiency perspective, second, from a risk perspective, and lastly, from a return perspective. Now, from a tax perspective, I think, like I stated, there was this change in the last finance bill, which allowed a certain categories of funds which invest more than 35% in debt and less than 65% in debt to qualify and get a long-term capital gains benefit of 12.5% if you held these funds for more than 2 years. Now, this compares very favorably with a debt mutual fund, which is taxed at the marginal rate of an investor, which is the slab rate, or a fixed deposit, which is also taxed both from a long-term and short-term perspective at full taxation. And this is where I think these funds provide a significant edge over the other two categories in that if you hold for 2 years, you get a tax benefit in the long-term category for 12.5%. So that's a big starting point and a big differentiator in this fund over the others. From a risk perspective, I don't think there is significant difference in risk because if you have to look at a traditional fixed deposit, depending on the underlying quality of paper, it could be very low risk if you play the government securities or the AAA. In most debt funds, again, depending on the underlying paper we buy or the duration we play, the risk on is different. So if you buy a high quality AAA oriented fund with a low duration, the risk is minimal. Now, if you come to income plus arbitrage, given that the underlying is fixed income, there is an element of both credit and duration risk, but most, if you play it in the lower duration bucket, the risk is minimized. And from an arbitrage, while it appears in the equity category, these are completely hedged positions. So from a risk perspective, these are low to moderate. Now, from a return potential, I think the big differentiator, like I mentioned in the first point, is through from a tax differential.
Okay. Gaurab, why should I look at an arbitrage fund right now? If I'm getting a mix now of an income plus arbitrage fund of fund, which is a debt fund as well as an arbitrage fund, then what is the point of an arbitrage fund now?
So I think arbitrage funds have a different positioning. If you're looking to park money between 6 months to, let's say, 24, 36 months, arbitrage is a good strategy to buy. Income plus arbitrage is what we are saying is filling the position of a core fixed income holding, which post the taxation 2 years back was losing favor because everything was getting taxed at a full investor's slab rate. This category has given a fresh birth of life from an investor who's looking at a core fixed income allocation, albeit with a little sleeve of arbitrage coming through. And this is where I think there is a big difference between arbitrage. Also, if you have to look at past history of arbitrage funds, there are at times when returns from arbitrage funds have come below the fixed income fund rates. And that's why a combination of both makes it a great proposition.
So how much should I have in my overall portfolio if an investor is looking? One, how much should your allocation go to an income plus arbitrage fund? Is there a percent that one should look at right now and versus an arbitrage fund and a debt fund as well?
Sadly, Vinnii, there is no straight answer. It all depends on your asset allocation, your risk profile, what is your goal you're investing for, and all of that. I don't think there's a straight jacketed answer I can give that for every 100 rupees you need to put 15 to 20 rupees in income plus arbitrage. It all depends on what is the investment purpose, what is the risk tolerance, and all of that.
Okay. And for which type of investor profiles are these funds the most suitable? Are there any specific goals or risk appetite that an investor should watch out for, that if this is their risk appetite, maybe this is the best category that they could look at? If you could, break it down for us here.
So again, there is no particular investor type. I think the point we want to emphasize is that fixed income should be a critical part of your overall portfolio. I think fixed income plays a very important part in a client's portfolio because it's counter-cyclical in nature. Now, given that, we can break fixed income into 3 buckets. One is the liquid bucket, one is a core bucket, and one is a satellite bucket. And what this fund tries to fulfill is the core bucket of any fixed income investor. In that, it tries to give you very stable returns with very limited amount of what we call interest rate risk. And again, depending on what you're investing for, what is your end goal, this is where the fund fits in very well. So it could be for a very aggressive investor looking to park money for 2 to 3 years, great option. For a very conservative investor who is saying, look, I don't want to play too much on equity, but want a significant portion in fixed income, this will fulfill the aspiration of that investor as well. So it plays across investor types. It has to be seen as a core holding and a substitute for traditional fixed deposits in the core bucket.
Okay, and how much of a data point, is there any data point which is available in terms of returns versus an other fund that you can compare to in terms for overall income plus arbitrage fund? Have we seen any outperformance coming in here?
Over arbitrage, yes, there are definitely pockets, like I mentioned, where this fund has outperformed. The data points are very simple. If you were to take any of the underlying debt funds which the fund invests and the arbitrage, and given that these categories have been in existence for quite a long period, there are enough and more data points which come through on a backtesting method. And there are clear pockets of outperformance of this strategy compared to arbitrage or fixed income in standalone cases as a combination.
Okay. Gaurab, in a normally a low market volatility time that you see, does this fund actually sustain in terms of returns over arbitrage strategy? Is that something that is seen in the past?
So again, there are pockets, like I said, very difficult to guess the future as to what will play out for this fund to outperform. Each fund has a different positioning and a different place in a client's portfolio. clearly, we don't think this is a arbitrage or income plus arbitrage. For the way I would play it, it is income plus arbitrage and arbitrage, depending on the underlying investment tenure and the risk profile. So I don't think we should be looking at a plain substitute of arbitrage. Each of them have their own pros and cons, and you have to look at what you're investing for and look at this strategy from that perspective.
Gaurab, I just want to try to understand from the fund management side point of view as well, right? Because how does fund of fund structure work in terms of the practice as well? Does the fund only invest in house schemes, as well as what is the process of selecting also, right? Because then it's a fund of fund. So how does that also work? And as a parameter, I'm going to put in one more question. As a parameter for investors, how should we be selecting, in terms of the income plus arbitrage funds?
So again, very interesting question. If you look at the various income plus arbitrage fund of funds in the market, fund houses have been running multiple strategies. So there are fund houses which predominantly invest in their own funds, like us. There are fund houses who've chosen to invest in other fund houses as well. The primary objective of the way we've structured it is, if you look at how investors have reacted to fixed income funds in the past, while India typically has a lot of money in fixed income, most investors in India clearly don't understand the concept of volatility, which comes from interest rate risk in fixed income. So what we are trying to address here is, can we give a strategy which in a way tries to negate the volatility of a fixed income investor and give him the stability of return? Hence, for us, the underlying choice of a fund is something which I mentioned earlier, is a fund which meets the core allocation of a fixed income investor. Now, what is the definition of a core allocation? Is that any fund which has the ability to control credit and has the ability to control duration is what we believe is a substitute for a traditional fixed deposit. And that's what we've tried to assess. Again, every fund house has their own investment objectives. Some play it within their fund houses, and some have chosen to also go outside of their fund house.
Okay, sure. And is there a checkbox that I should look at as an investor? I just want to know that. What are the points? How do we judge this fund? Is this historical data point? What are we watching out for when we are picking out income plus arbitrage fund as an investor?
So at the cost of being repetitive and to an extent being biased, I think investors, when they look at income plus arbitrage, are trying to fulfill what we call, again, the core allocation of traditional fixed deposit. So if you have been a fixed deposit investor, what have you chosen a fixed deposit? Because A, it gives you some stability of return, and B, it has a limited duration, and hence the volatility, underlying volatility is limited. Now, if you have to replace a fixed income mutual fund, the mutual fund should be able to display both the characteristics in that it invests in high quality paper, and B, it limits the volatility the fund has due to interest rate risk. So for you, the tick box should be, is the underlying fixed income fund meeting both these characteristics?
Okay.
Or is the underlying debt fund being so wide and open that it could have an element of volatility kicking in?
Sure.
And whether you are able to fathom that volatility or not. And that's what the tick box is all about.
Okay, Gaurab, thank you so much for that. So that is what we spoke about in terms of income plus arbitrage fund of funds. But on that note, we're going to slip into a very short break, viewers. Then we'll talk about more in terms of asset allocation. How does all this play in your strategy as well? So don't go anywhere. Welcome back to Mutual Fund Corner on CNBC TV 18, and we still have with us Gaurab Parija of Bandhan Mutual Fund, and now we're going to be discussing a bit more in terms of good asset allocation in mutual funds. You have so many options. Gaurab, we spoke about a newer option which has started trending right now. Now, every time you have something that is increasing in terms of space and pace, right? You had sectorial funds that were there last year. A lot of investors jumped into it. Then you had income plus arbitrage funds that is coming in, index funds that is there as an option as well. What is the asset allocation, and why is it important to consider it according to your goals as well, right? Because just allocating to different funds is not making strategy. Goal is also going to be important for me. So if you could take us through all of that.
So thanks, Vinnii. I think boring as it might sound, you have to ask any one of us in the financial markets, if there is one secret sauce to creating wealth in the long run, it is asset allocation. So what is asset allocation? Very simply, each investor has multiple assets they can buy into. One is equities, Within equities, you have international equity, you have domestic equity. Within domestic, you have large cap, mid cap, small cap. Then you have fixed income. You have traditional fixed income. You have multitude of debt funds. You have commodity-based funds, sectoral funds, thematic funds, real estate. Now, if you are to look at multiple reports, there's a fascinating table which looks like a periodic table in chemistry, which shows that depending on underlying market cycles, economic cycles, asset classes move in give very different returns over periods of time. And hence, it is important, depending on your underlying risk profile, the reason you're investing for, to choose an asset allocation. In fact, there's a very fascinating study which was done in the US by Brinson Board and Hood and Bribauer, which asked people what was the reason they could create so much wealth. And surprisingly, 92% of the attribution of wealth came from the fact that these investors got their asset allocation right, as against their ability to time the markets or pick the right stocks or funds. And hence, I think it's very, very critical to look at asset allocation. I think when many a time when we discuss this, many people are put off by the fact that it is so boring. It's not something which is very, very exciting. But like most pundits will say, if you are in investing, it should be boring. And hence, if you get your asset allocation right, your underlying goal, that pretty much will ensure whether you end up having a great portfolio or not.
Absolutely, Gaurav. But, there's a rule also, right? 100 minus your age is what you should invest. Is that also a factor that comes into play? How should investors actually decide the right amount also of allocation, right? It's just that if I'm investing a very small amount and then expecting a good return and expecting to become and create that wealth, that also won't work, right? So risk, age, the amount of investment, how important is that?
So let me try to give a very layman perspective of what asset allocation should look like. Let's for one moment assume that I have to go from point A to point B. And in my case, point A is my office and point B is your studio. My choice of vehicle would be I could pretty much walk down or at best take a cab to reach your studio. But let's flip it for a moment and say point B now moves to the United States of America. For clearly, my choice of transportation has to be very different if I need to reach it quickly. In the same manner, asset allocation cannot have one color to be pasted saying, oh, if you are in the age group of 25, your asset allocation should be 100 minus 25, or if you are 75, it should be 100 minus 75. Because I think a lot of the dependence on asset allocation depends on what is the end goal. For example, if I am a person in the age group of 25 but want to buy a house 2 years down the line, irrespective of whether I'm a very aggressive investor or I have a long multitude years to live, for the underlying goal, I need to be far more conservative than my traditional risk profile. So I think asset allocation combines a risk profile of the investor. Most importantly, it also looks at the tenure of the investor and then breaks it down as to which asset class you should go in. There is no static rule which says 100 minus age is what you should be doing from an asset allocation. That's a very broad way to look at it, but you need to cut and slice depending on your goal.
Absolutely. Depending on your goal and how fast you want to reach that destination is going to be important. If you want to fly faster, then I'm sure you need to invest the more amount of money as well coming in. But yes, that's depending all on your goal. But how often should asset allocation actually be reviewed? Given that, it's such an uncertain time right now, I want to understand that how important is rebalancing also in terms of your portfolio?
See, I think there you can have a broad rule. Typically, over the last 25, 30 years, I have looked at it at every 6-month window. Some people do it annually, some people do it quarterly. I think more important than the review frequency is your ability to stick to your asset allocation. I think as human beings, we typically have the emotions of fear and greed. Sometimes when a particular asset class in your portfolio tends to do well, you tend to start greedy and start overweighting that asset class, and vice versa. Many a time when markets move very sharply, you tend to either panic or tend to revisit the asset allocation. I think that's where the critical issue is. It is don't overdo it. I think many investors try to look at asset allocation on a daily basis. It's like you plant a tree and if you look at it, it's not going to grow every day. So it's a good practice to do it once in 6 months. And that should be more than sufficient for you to maintain the asset allocation. Okay. Obviously, if there are times when markets really crack, then you might want to revisit it. But that's very few occasions when that will happen.
Okay, very few occasions where that will happen. Can you share an example of how asset allocation has actually helped investors manage volatility during, market downturns, upturns? What is it, and how this is actually important? Because sometimes people just think that it's not that important. And I just wanted to explain them with an example of how this has worked.
And a great way to look at how asset allocation works is actually to look at a category of funds which is called multi-asset allocation funds. And if you are to take the example of multi-asset allocation funds, and if you are to look at period 1st February to, let's say, 26 September 2024, when markets were doing very well, the Nifty 500 typically returned around 25%, and the underlying multi-asset funds returned around 20%. So in a way, it was able to capture most of the bull market returns. On the flip side, when the markets did correct, and Nifty 500 from 27 September till end of November fell by close to 8%, most of the multi-asset allocation funds protected the downside and fell by 4%. Do remember, in your investment journey, it's not only important to capture the bull market, but it's very important to protect the downside. And that's what a typical asset allocation does. And a great example of that playing itself out is the multi-asset allocation funds, which has done that journey over the last year.
Okay, absolutely. That's an important way to judge also in terms of how you can view this as well in terms of asset allocation and how it's going as well. But are there any common mistakes that you would highlight in terms of asset allocation and how an investor should avoid them? A quick one.
3-4 of them, like I mentioned, typical tendencies to chase performance, which is called recency bias. So if you are an investor, let's say in late September, in September 24, equities looked very good and everything was hunky-dory, and you tended to have more allocation in equity. And hence you overweighted, and then lo and behold, the markets took a turn, and then we got napping. Secondly, I think many people have the other bias, which is called overconfidence bias, believing that they have an ability to handle risk more than what they believe they have, and hence they tend to ignore their risk tolerance. Third, many people start with a great intention of doing asset allocation, but never ever rebalance. So it's all in paper, but never executed, because there is could be a feeling of complacency. And lastly, I think over concentration. A good asset allocation plan, depending on the underlying goal, should be well balanced and not overweighted in an asset class which an investor believes he likes.
Okay, Gaurab, thank you so much, for joining with us today on the show, helping our viewers understand the income plus cost arbitrage fund of fund, as well as how they should be allocating their money and all these funds and options that are available for them in the industry. So thank you so much, Gaurab, for joining in with us. And viewers, thank you so much for tuning in as always. With that, we'll wind up this edition of Mutual Fund Corner. Thank you from myself as well as the team who put this show together. But don't go anywhere. Up next, we have Closing Bell.